Good morning. Whether you're an experienced Forex trader or new to the market, understanding how the bond market works, especially yield spread analysis, can clarify what drives currency movements. To start, let's get clear on what bonds are and why they matter to currency traders. At their core, bonds are debt instruments issued by governments and corporations to raise capital. When someone buys a bond, they're essentially lending money in return for regular interest payments called coupon payments plus the promise of full repayment at maturity. What makes bonds so pivotal in the world of Forex isn't just their role as safe haven assets, but the fact that their yields reflect expectations about inflation, economic growth, and central bank policy. The more traders understand this, the more they can anticipate currency moves before they happen. Bond yields and currencies are closely connected because both are heavily influenced by interest rate expectations. When yields on a country's bonds rise, especially relative to another country's bonds, it often signals that interest rates might be heading higher. This is key in Forex trading because higher interest rates generally attract more foreign capital, driving up demand for the domestic currency. So, when U.S. Treasury yields are rising faster than German bond yields, for example, the U.S. dollar tends to strengthen against the euro. This is where yield spread analysis comes into play. Yield spreads refer to the difference between the yields on two different bonds. In the Forex context, traders often look at the spread between government bond yields of two countries whose currencies they are trading. For instance, when analyzing the euro to U.S. dollar pair, one might compare the yield on 10-year U.S. Treasuries to the yield on 10-year German bonds. If the spread widens in favor of the U.S., it suggests that investors expect better returns in the U.S. compared to the Eurozone, which can cause the dollar to appreciate. The same logic applies when comparing the British 10-year gilt with a U.S. Treasury yield to analyze pound sterling to U.S. dollar movements. Now, while that concept might sound simple on the surface, it's the interpretation of these spreads that makes all the difference. Traders should not only look at the absolute level of a yield spread, but also at its direction. Is the spread widening or narrowing? A widening spread in favor of one country usually reflects stronger economic momentum or more aggressive monetary policy in that country. Conversely, a narrowing spread might indicate an economic slowdown or dovish policy outlook. Observing the trend in spreads can help a trader get ahead of major Forex moves before they're visible on the charts. It's also important to distinguish between short-term and long-term bond yields. Yield spreads on shorter maturities, like 2-year government bonds, are often more sensitive to central bank expectations. When comparing 2-year yields between two countries, a widening spread often reflects diverging monetary policy paths, such as one central bank hiking rates while the other stays on hold or cuts. On the other hand, yield spreads on 10-year or 30-year bonds reflect not just policy expectations, but also inflation outlook, growth trends, and investor sentiment over a longer horizon. Savvy Forex traders often monitor both short and long-term spreads to get a fuller picture. Let's try to visualize this. Imagine a scenario where the U.S. Federal Reserve is signaling multiple rate hikes due to persistent inflation, while the European Central Bank is maintaining a cautious stance due to slow growth in the Eurozone. If traders see the U.S. 2-year yield rising while the German 2-year remains flat or even declines, the spread between the two will widen. This sends a signal to the market that capital will likely flow into U.S. assets, increasing demand for the dollar and leading to a potential euro to U.S. dollar sell-off. A trader who has studied the yield spread ahead of time can position themselves accordingly. That is, often well before the chart shows a clear breakout. But no analysis should happen in a vacuum, and this is where many traders fall short. Yield spread analysis is powerful, but it must be balanced with other critical factors. Economic data releases like GDP, employment, inflation, and retail sales still matter. For instance, a positive yield spread might support a stronger currency, but if upcoming economic data disappoints, sentiment can shift quickly. Similarly, central bank speeches, geopolitical risks, and risk sentiment, whether markets are in a risk-on or risk-off mode, all shape how investors interpret yield differentials. Another key consideration is the direction of capital flows. If foreign investors are buying up a country's bonds due to attractive yields, it naturally strengthens the currency. But if geopolitical tensions or debt sustainability issues arise, investors might dump those same bonds, causing yields to spike for the wrong reasons and the currency to fall. This is why traders should always analyze whether yield changes are happening for fundamentally good or bad reasons. Rising yields driven by stronger growth and a healthy economy tend to be bullish for a currency. But rising yields caused by a loss of confidence or inflation fears can have the opposite effect. Traders should also be aware of the concept of real yields, which are inflation-adjusted yields. Sometimes nominal yields rise, but if inflation is rising even faster, the real yield might actually be falling. This nuance is critical because currencies respond more closely to real yield differentials than to nominal ones. When comparing the dollar and the euro, for example, if US real yields are rising while Eurozone real yields are stagnant or negative, this is a bullish signal for the dollar. Many institutional traders use real yield spreads as a more accurate gauge of expected returns across currencies. Positioning and sentiment data can further refine how traders use yield spreads. Knowing what the broader market expects, whether the current yield spread is priced in or still being digested, can help determine the potential impact of shift. If everyone is already long the dollar due to a favorable spread, the market may be vulnerable to a reversal even if the data supports further gains. This is where tools like the commitment of traders report and sentiment indicators come into play. They help traders decide whether to ride the momentum or prepare for a potential correction. For practical implementation, traders can integrate yield spread analysis directly into their trading plans. One way is to track the daily changes in key spreads such as US minus German 10-year or US minus UK 2-year, and compare those to the currency pairs they are trading. If spreads are moving in favor of one currency, that's a signal to start aligning trades in that direction. Another method is to use yield spreads as a filter for trade setups. For example, if a technical chart pattern suggests buying euro to US dollar, but the yield spread favors the dollar, it may be wise to hold off or look for confirmation elsewhere. Yield spreads, when used properly, can keep traders out of bad trades just as effectively as they can guide them into good ones. As we've seen, bonds and yield spreads offer Forex traders a vital layer of insight that goes far beyond chart patterns and economic headlines. By understanding what these spreads represent and how they reflect interest rate expectations, investor sentiment, and capital flows, traders can develop a more nuanced and forward-looking view of the currency markets. However, like any tool, yield spread analysis is most effective when used alongside other forms of analysis, such as fundamental data, risk sentiment, and technical signals. In a fast-moving, interconnected world, no single indicator tells the whole story. But for those willing to learn and apply it thoughtfully, bond yield spreads can provide a serious edge in Forex trading. Till next time, have a great time trading. Thank you.